higher time frame, just forget that altogether, because you want to be waiting for the market to really be moving a significant measure of pips before you even consider moving that stop loss from the initial point at which you entered the trade. And you're going to have to learn to exit at logical targets and look to re-enter at a later time. We can take positions off at logical areas of resistance when we're in a long-term trend. And instead of sitting through a measure of drawdown on our P&L, what we would be doing is actually exiting the position, or maybe some of the position, and we'll talk about this when we go into trade management. We're actually going to specifics. This teaching here is just to get your mind thinking about some of the things that's going to plague you as a long-term position trader. But if you're looking at a long-term trade and you're bullish on, for instance, the dollar yen, and you get to a level where you would reasonably and with high probability expect some resistance or some retracement, you may take some of your position off. You may take half your position off. You may take 3/4 of your position off, a third of your position off, 1/4 of your position off, and allow that to be in your account as a profit. And then once it retraces back to a level where it would be logically time to see another move higher in your long-term trade, then you can add back that position, or maybe a little bit more than what you profited when you took off a quarter. Maybe you'll put back on a third. Maybe you'll put back on a little bit more than a quarter, okay? Or you'll just put back that original quarter you took off for some partial profits, and then you can add it back and you can get a larger position built on and see that next leg price higher, where you would make more money than you would have if you just would have kept the original gearing and entry point at the point of entry. And finally, long term is not get rich quick, but get rich steady. So before you go into the next series of teachings, where we actually go into a little more detail about what it is you're actually doing with long-term position trading, just know that you are not going to see velocity for your money trading these higher time frames. It just isn't there. Now, velocity is how fast you put your money at work and it makes a profit for you and you get it right back right away. That's velocity. That's why I like day trading, because I can compound my money very quickly. Some of you cannot do that, and don't feel that you can't be profitable because you can't do that discipline of trading, so therefore you can't be profitable. That's not true. You can make very, very handsome returns on just long-term position trading, but it has to fit your psyche. It has to fit your inner trader, that person inside of you that makes who you are as a trader. It has to fit that criteria of that inner person, because if it's at odds with your thinking process, you can't, no matter how you slice it, it's going to be at odds with you. You're not going to be able to sit through the trades. You're going to force things because you're impatiently waiting for something to come to fruition, and it's just going to be a problem. So the money management aspect will become harder for you if you can't get yourself in alignment. But every one of you in the mentorship should be trying to apply long-term position trading to some degree for the remaining portion of this mentorship. And you'll see how you don't really need a whole lot of skill in terms of entry technique. Okay, the entry techniques you're actually going to learn is rather simplistic. And some of you will probably start using it a lot more frequent than I do if I was long-term position trading. But for long-term position trading, it's the style of entry that I use. And when we get into all the entry techniques and concepts, you'll learn it there. But before we get into trade entry and stop loss orders and how much money should I risk and all that business, you have to have some broad brush ideas about money management. And that was the core point of this teaching, because I want you to have the mindset going into it with, yes, you're managing money. No, it's not going to be a whole lot of trades. It's not going to allow you to parlay that account quickly, and it's pretty common sense. But some of you are so new and you're naive to the fact that these time frames require a great deal of time. And by having that submission to time, it will allow you to, number one, improve your overall analysis, because what you see on these higher time frames, that's what directs the lower time frame to move as they do. But your objective, if you're going to be a managed fund trader and you're going to be trading other people's money, OPM as they call it, other people's money, that career is very lucrative, especially if you are consistent with your rate of return. And if you can consistently pull 20% or 25% every single year, and you're only doing a handful of trades. Now think about this. We've already mentioned that there's very little trades going on this higher time frame. So if you have every 3 months, there's a potential trade that could theoretically form every 3 months. It doesn't work like that though, folks. I look personally for 2, and if I'm lucky, 3 good position trade setups a year. So that means over the course of January to the end of December, you're probably going to see 2 very simple, easy to find long-term trade setups. Maybe if you're lucky and you're really dialed in and the market's really working well,